Let's get to the broader markets. Our next guest is bullish about the new year, says worries about tech's high valuations are misplaced. Joining us here this morning at Post 9 is Talley Leger, Chief Market Strategist at the Wealth Consulting Group. Nice to have you in, T. Welcome.
Thank you. Good to be here. Feliz Navidad.
You're pretty constructive on next year.
Yes, and I'm glad we're sitting down for that conversation because we see the S&P 500 achieving 8,500.
8,500, driven by?
Well, we see earnings rising, rates, as you were saying, coming down. And there's a lot of negativity that we think can power the stock market higher as sentiment improves.
Focused on the traditional AI trade, or does this thing continue to broaden?
Well, I think that tech itself should enable a broader market, to your point, Carl. And it's that innovation we think is going to power a catch-up phase for the rest of the market, including small caps.
So margin expansion in addition to earnings, this part of the same story.
Absolutely.
Is that what drives the Fed to cut in that case?
So I think that on a trend basis, we are seeing a stability in inflation, if not a bit of a cooler dynamic. In fact, if you look at the consumer sentiment index, 5-year inflation expectations have done a round trip. They've come back to where they were exactly a year ago, which is amazing to me.
If you look at some of the outperformance lately of the cyclical groups, industrials, financials, energy have done really well lately. Some people are wondering if it's pricing in the better economic growth outlook that is expected next year, which is what a lot of these bullish views are based off of. Does that concern you? It's already happening?
No, I think that positioning and sentiment is still in the buy zone. A lot of bearishness here. When we get to extreme optimism, I'll let you know, but we're not ready to wave the checkered flag on this rally. We love the cyclicals because financial conditions are easing here and supporting a reacceleration, we think, in the broad economy.
So your view is that the cuts we're getting are nice to have, not need to have, as we like to say around here. Is there a point where it gets to be a need to have?
Well, I think that the silver lining of the story, you mentioned margins, is the weakness in the labor market. So that, if we had a concern, would be a potential headwind for next year, an acute softening in the labor market, and that, again, would kind of reinforce this notion that the Fed needs to keep cutting rates.
Right. That's behind the more bearish calls we're getting now, is that, yeah, these productivity stories are amazing, and the margin story might also be amazing. It will come at the expense of consumption. Do you think that's not a risk?
Well, consumption has been coming in at record levels, right?
Oh, I know.
Yeah.
We're talking about 26, though.
Yeah. Well, so I think the point here is that as long as sales keep accelerating and payrolls keep decelerating, that's your basic recipe for margin expansion.